I've been advising clients for a long time, and the perception of wealth is often different to the reality. I'm going to give you 6 steps to wealth. Many people are looking for a silver bullet to super richness. These are exotic solutions, and they do exist. You've got things like, for example, being born rich, or marrying a billionaire, or winning the lottery. But the chances of that are pretty slim. You're just as likely to win the lottery grand prize as you are to be killed by a vending machine, or be killed by a falling coconut, or die in an asteroid strike. You get the idea. So, how does the average person with average earnings become very wealthy? Step 1: automate your savings. What I often find when I'm dealing with wealthy people is that they are diligent. And the most important part of being diligent is with your own finances. And you'll find that as you're earning more and more, your lifestyle just kind of tracks it. It will gradually go up. So you spend what you bring in. So you find that quite often people don't have any extra money, even if they earn a lot. So that's where diligence comes in. And in reality, the best way to do that is to automate your savings by carving out a certain amount every month of your pay into savings, 10 or 20%. And what will then happen is your spending, your lifestyle will be curtailed effectively, naturally. To give you an example of this, have you ever found that you've got a particularly nefarious bill and it's given you this anxiety because you kind of know how close you are to the spending limit of your month? That's because your lifestyle is naturally consuming your wage. What you need to do is carve out that money, and then your spending will naturally reduce, even if you're not tracking it. And what that will do is give you a cash pool. And that will put you ahead of around 30% of the population of the United Kingdom and the United States. Because a third of the population have little to no savings at all. Step 2: ensure your life, income, and your house. I'll be brief with this point because this you'll find dull. But insurance is very important. A catastrophe can destroy your finances, whether that be your life, if it's your family or left over, or if it's your income, if you're injured. Remember, morbidity is much higher than mortality. You're much more likely to get ill than you are to die. And therefore, it's more important to insure your income in many cases than it is to insure your life. And also, if you're very young, it's quite cheap to do so. So make sure you don't destroy your finances by a lack of insurance. Step 3: avoid unnecessary debt. If you've ever seen someone drive past you in a Lincoln or a Ferrari, you might want one. But actually, do not buy one when you're not at the stage where you could technically buy it outright. Debt is corrosive. And yes, there's some debt that you need. For example, you need a house. You don't want to live in someone's garden. So you need to be able to live somewhere. So there's some debt that you need. But minimize the debt that's just lifestyle debt, where you want to buy the new thing. Don't do that because it will destroy your finances. Some pain now is better for gain in the longer term. Step 4: invest. You may have heard the term cash is king. Well, no it isn't. Cash is king is designed for businesses because bad cash flow can kill a business. For your own personal finances, however, cash can be corrosive. And you do need to hold some cash, circa 6 to 12 months expenses, plus anything you're planning to buy in the short term. The problem is that cash tends to underperform inflation over the longer term. If you were to take a basket of goods in 1925 costing £10, that same basket of goods today would cost over £500. And that is because of the effects of inflation. Yes. So if you held your money in cash over the last 100 years, well, you'd be dead. But you'd be dead and poor. Whereas if you invested your money in, say, the S&P 500 as a proxy for the market, the S&P 500 has delivered over 10% per annum for the last 100 years and about 7.5% net of inflation. So had you been invested in the S&P 500, your money would have been growing in real terms over the longer term. And yes, the markets do contain some risk. The markets go up and down, they're volatile. But so long as you are well diversified, you can ride out market volatility over time. And that is why investing your money is absolutely crucial for the long-term wealth journey. Step 5. Utilize appropriate tax wrappers. You may have heard of the villain known as the tax man, but there's a lot that you can do about tax. The problem is you could write a book about tax. There are books about tax, but I'll try and summarise some of the key points. Pensions. So there's been a lot about pensions recently in the press. Ignore all of that. Pensions are still hugely efficient. So long as you invest in them within the allowances. As an example, for every £8,000 you put into a pension, the government will add £2,000, so you get £10,000. And if you're a high rate taxpayer, you can reclaim through self-assessment an additional £2,000, which you get back as cash, and you can do whatever you like with it. So for your £8,000, you've got £4,000. You've got a 50% uplift on your investment. And even when you come to take the money out at the end, 25% is tax-free, and the balance is taxed as income. So let's say you've stopped working and you've got your personal allowance back. If you draw that balance within the personal allowance, it's still tax-free, and then it goes through the bands. After that, you've got the individual savings account, the ISA, £20,000 a year, and can be invested into an ISA, either cash or stocks and shares, and that will protect it from all tax, with the exception of inheritance tax. After that, you've either got the general investment account, which is a sort of naked investment subject to all the normal taxes, capital gains tax, dividend tax, interest tax, but you've got your £3,000 capital gains exemption to use against it. And then you've got investment bonds, which is a different tax regime, but they can come into play sometimes. That's going to require a completely separate video. After that, you've got the likes of the Venture Capital Trust, which is essentially an ISA, but you get 30% back on your invested capital against your income tax bill. So if you put £100,000 into one and you've got an income tax bill of more than £30,000, you can get £30,000 back. And then you've got an enterprise investment scheme. It doesn't function like an ISA, like a VCT, but it does become inheritance tax free, and you also get your 30% capital back. So the problem with them is that they are risky. You're invested in small companies. You get a tax break for a reason. But the point is to say that there's lots of things you can do about tax. Tax, again, can mitigate against the growth of your wealth over time. And if you manage it properly using the correct tax shelters, you can really ramp up your wealth and growth of your capital over time. Number 6, time. Now, you will want to become rich immediately, which I understand. But for the average person, it's going to require earnings managed well over time. But even the average person following these steps can become a millionaire given that time. And to put that into context, let's say that you are putting away £200 a month into savings, and you've got another £200, say, a month going into your pensions through your own contributions and that of your employers. That's £400 a month. £400 a month growing at 7% a year, as an example, for 40 years, say over your working life, that will amount to about £1,049,000. So on top of your house, that's an investment, that's capital of over £1 million. So the average person can be a millionaire if they manage their wealth well.